Today's guest is Eric Wiklendt from Michigan-based Speyside Equity, a private equity firm that buys lower middle market manufacturing businesses and then does the hard part, fixing what's messy, improving operations, and building real value the old-fashioned way, rolling up the sleeves by actually improving the company. Eric and his partners love hairy deals, carve-outs, complicated stakeholders, weird seller constraints, the kinds of situations where structure matters and most buyers step out. Thank you, Eric, for coming to the Buyers and Builders podcast.
Well, thank you very much for having me this morning, Mick. Really appreciate it.
In one of your previous interview, you've said that you would do this job for free. You love it so much. So, what keeps it fun after 10 years of doing this?
Yeah, for me, I really enjoy the intellectual challenge of solving the problems that come with underperforming businesses, especially, or businesses that need to be grown. So, in my personal opinion, shutdowns, turnarounds, and startups are, where the most change occurs in businesses, and that gets me really excited to be involved in that sort of situation and change, because that's where you really need to put your thinking cap on and decide how the business is going to go going forward. So it's a little bit like playing a sport or a game, and it's like the most fun and exciting sport or game you can play because it's so challenging.
So Speyside is a firm designed by operators for operators. Can we maybe cover some of your early experience before everything what you do with Speyside?
Yeah, absolutely. The three of us that are partners at Speyside, myself, Nick, and Kevin, we've all been C-level guys at manufacturing businesses. Kevin and I both been CEOs, and Nick's been a CFO. But myself personally, I grew up in Detroit, Michigan, or in the Detroit, Michigan area. Most of the people that work at our firm are from Michigan. After growing up in the Detroit, Michigan area, I went to undergrad at Notre Dame, and then came back to Detroit, and I was a consultant, primarily focused on strategy and operational improvement in manufacturing companies. So I had some big clients that everybody's heard of, back then, but primarily my clients were middle market manufacturing companies, especially servicing like the automotive industry. Given that it was Detroit, which I really enjoyed. I really loved learning how those companies worked and whatnot. And I kind of figured out though that like being a consultant long term was probably not what I was going to do. I didn't want to change the world one PowerPoint slide at a time for the rest of my life. And as a result, I kind of figured out that I wanted to run or invest in manufacturing companies, and I needed more education to do that. So I went back to Wharton, got an MBA there, and then worked at several manufacturing companies prior to joining Speyside. And those experiences were great. So I worked at Eaton and Hilti Corporation, had a lot of really interesting roles. I really tried to seek out change management roles in those companies. Just because I knew that that would be really good experience for what I ultimately wanted to end up doing, which was running a manufacturing company or investing in manufacturing companies. So I did things like, started up a plant in Mexico as the plant manager, fixed a broken supply chain, took over a 70-person industrial sales force in the Rust Belt after the global financial crisis, ran a marketing department that I reorganized, did corporate M&A and strategy for a while there as well. And then ultimately I did become a CEO of a small manufacturing company that made HVAC products, sold that off, and then joined Speyside and have been at Speyside ever since. But those roles really formed a lot of how I think about investing now and what we do with the sorts of companies that we buy, which is improve them. We like to call our strategy a fix and build strategy. So phase one is the fix part, where we will improve the EBITDA margins. And part two is the build part, where we will grow the top line. And we do that through what we call our Portco value creation system.
Okay, you already went into this. Let's maybe first cover a bit of the timeline of the fund, like Fund 1, then you did a continuation fund in 2023, if I'm correct, and then you just raised Fund 2 in 2025. So as you've said before, you're just Midwest guys who's willing to do the hard work. But let's maybe talk about the fundraising for the Fund 1 first.
Yeah, absolutely. So prior to Fund 1, raising Fund 1 in 2016, we were basically an independent sponsor family office model. So Kevin Doherty, my other partner, he started Speyside back in 2004, where he basically did entrepreneurship by acquisition. He bought a company from Evonik, which became Sweet Ovations, and that was the Adamus of Speyside. And then for those 12 years, it was, basically bootstrapping deals with our own money and whatnot. But then in 2016, we raised Fund 1, which was our first institutional fund. And that worked pretty well. It was 130 million. We were oversubscribed, which was good. And then we invested that money pretty quickly, probably a little faster than we probably should have, but that went pretty well. And then 2019, 2020, we reformed the fund a little bit. There were some different things going on. Some guys wanted to spin out. Kevin was thinking a little bit about how things should go. He had some challenges, around thinking about how to, raise the next fund. So we kind of put that on pause a little bit. And then in 2023, I really took over fundraising so we could do the continuation vehicle, which worked out pretty well. That was a single asset continuation vehicle for Opta. And then in last year, in 2025, we finished up fundraising Fund 2, which is a $300 million fund. Good news was we hit the hard cap and we were oversubscribed. Bad news is we had to turn away some people at the end. You want to try to get as, folks that did all the hard work in, but the good news is we had plenty of demand. We think that was pretty good, a pretty good situation, given that a lot of funds nowadays are having challenges raising funds, or they're just going out of business altogether.
Now, if we take the fund number 1, you said you raised 130 million. How do you decide whether you're going to raise 100 million, 130 million, or 150 million? Because you also said that you deployed this capital pretty fast.
It's a calculus of portfolio construction. And so we'll say, we'll think about, like, we want to put 8 to 12 portfolio companies or platforms into the fund with a certain amount of bolt-on investment. And so what you kind of do is you take, like, the size of the fund that you raise, you back out the fees, which, just for simple math, it doesn't work. It steps down, but for simple math, 2% of the assets under management for 10 years is kind of a good rule of thumb. And then what's left is what you have to invest. And then based on that tells you how many platforms you can do, depending on your average equity deployed, amount of equity deployed per platform for both the platform and then the bolt-on acquisitions. So for us, for this fund, that means we'll probably do somewhere between 7 and 9 platform businesses in it. For our next fund, we'd probably want that to be a little bit higher, more like 10 to 12. But that's how you do it. And our next fund will probably be Fund 3. We'll probably target 500 million for that. So that would allow us to add 4 or 5 more platforms into Fund 3. It's also a little bit a function of your processes and your people, right? So we think a little bit about engineering what we call the process stack. You hear in venture capital a lot, like the tech stack. We think a lot about the process stack, which includes technology, people, activities, and data governance. And so when we think about that applied to our fund, it becomes, how you engineer the process stack is a function of activity velocity, or I should say activity velocity is a function of the process stack. So how well your processes work, how scalable and repeatable they are, also determines a little bit how fast you can deploy your capital. So it's usually a 5-year deployment period. And if your processes work well, you can find the companies you want to buy quickly. You can execute the deal transaction reasonably quickly, and then you can transform the business and exit it relatively quickly. And that also plays into how many companies you can buy and therefore how much capital it makes sense to raise.
In 2023, you decided to raise this continuation vehicle anchored by Elliott Management. Could you maybe talk a little bit about Elliott, because they're known as activist public equity investor, and how you found them or how they found you, and what got them excited about this opportunity?
So we used Jeffrey's bank. Jason Morris was the guy we work with primarily there, and we went out to the market to find potential partners that would be a good fit. And he introduced us to Cody Kittle and Mike McKeel at Elliott, who were leading the secondary strategy at the time at Elliott. And we thought it was a really good fit just because, I mean, obviously those guys are, Elliott's a bunch of super smart folks, but Cody and Mike were incredibly entrepreneurial, focused guys that, understood what we were trying to do with the business. So a lot of continuation vehicles, PE firms do them for kind of one of two reasons. I would kind of argue one reason's really good, which is why we did it, which is we needed more capital to execute the build phase of the fix and build strategy. And then, the other reason folks do it is just so that they can basically have a liquidity event and have realized returns, which helps them in their fundraising. But it isn't always necessarily like the right reason to do it because they're selling things at a discount that don't make sense. But we did it because we had lined up 7 acquisitions for Opta to do. And also we wanted to open several manufacturing plants. So over the last 18 months here, we did do 7 acquisitions and we opened up 5 manufacturing plants. So that was the, investment into the growth opportunity there. And then the goal would be to double the EBITDA, before we sell here in probably 2027 or 2028.
Okay, and then 2025, you raised fund to 300 million. It's like a third institutional fund. Could you maybe talk more about the experience and your overall view on the market? Because a lot of funds were struggling when it comes to fundraising, and one of your thought is that maybe over some of the years, PE has been becoming too big.
I mean, it was a challenging experience, of course, like to do a fundraise. We traveled all over the place, looking for LPs, and, we're really excited about the LPs we got. We tended to get really good folks focused on making returns, and they really understood our strategy pretty well. But what we heard from the market was, that LPs, they invested in our fund kind of for 3 reasons, primarily. Number one, we had historical, really strong returns. Number two, they really liked our very focused strategy. And our strategy is we only do manufacturing. We do it in the lower middle market, and we really like things where there's an opportunity to structure them appropriately because they're in currently misaligned ownership structures. And then we transform them using our systematic approach called our Portco Value Creation System. And then the third part was they like the fact that we tend to be very, very process and systems driven at Speyside. So having the previous returns, having a strategy that they thought makes sense, and then galvanizing that with systems and processes that are structured was pretty exciting to LPs, is what we heard, and allowed us to come in oversubscribed when a lot of funds are closing down. And, I guess my view of that is that, the PE industry maybe got a little bit too big over the last 20 or 30 years because money was pretty cheap with, zero cost debt and maybe some other things going on. And I think it's good what's happening now, honestly, which is there's a bit of a reckoning and a culling of some firms that don't generate a lot of alpha or aren't providing a great risk weighted return. And I think over the long term, that will be really, really healthy for the industry and also healthy for investors into it. And if you for LPs, right, they won't have to pick amongst, tens of thousands of funds. There'll just be less funds to pick from, and it will be a lot easier for them to pick the winners that are clear just because you're picking from a much smaller population.
Can you give us an example of, let's say there are two funds. It's Speyside, and then there is someone who's more focused and maybe strongly focused, heavily focused on financial engineering. And if you compare those two companies, you and them, how is everything different? If you can give some basic examples for people listening.
So it's a good question. Actually, a buddy of mine who works at Goldman Sachs, Sergio Perkovic, sent me a really good study that Goldman did, and it was all about how PE firms create value. And I would say we're a little bit of an outlier because we do it through operational improvement that improves the EBITDA and the EBITDA margins, right? And obviously improving the EBITDA, you know, if you have a company that's, 10 million of EBITDA when you buy it or something like that, and you make it into 20 million of EBITDA, it's gonna, if you exit it at the same multiple you entered, gonna you're gonna double the value. Well, probably more than double the value, but at least in that case, you've created a lot of value by improving the EBITDA. Whereas the other method, and we would use pretty low leverage profiles, or we do use low leverage profiles, usually like a 2 to 3x times EBITDA. Whereas what a lot of other PE firms do is they'll buy a business, and usually it's a more oftentimes more stable, better business than what we would buy, or consistent, I guess. And so they would take something, and instead of using a 2 to 3x leverage ratio, they would use a 5 to 7x leverage ratio. And therefore, they would put in a lot less equity than what we would put in. And as a result of that, theoretically, their return on equity should be stronger and better and higher. And you can do that when debt's really cheap, and also the economy is improving because you don't have hiccups. The problem is with a 5 to 7x leverage ratio, we've seen over the years, when the economy turns down, that gets difficult because your debt service is too high to be serviced by the EBITDA and the cash flow that the business is currently generating. And then that's where basically PE firms get their bad name. They start taking a bunch of difficult decisions and executing a bunch of difficult actions that get them in the press because their leverage ratios are so high and they have to service the debt. So we try to avoid that. It's not that you can't make money that way. You can. That's just not how we do it. We think it's a little bit risky, and we're really good at improving businesses operationally, so we focus on that. And it's a little more conservative, but the thing that we like about it, and I think our LPs like about it, is our risk-weighted returns are pretty good because we get pretty strong returns, or we have historically, but we're not taking on as much risk to get them.
Today's sponsor, CapitalBad, is all about building an enduring private equity firm, backing founder-led businesses, protecting downside, and compounding capital in smaller, relationship-driven markets. That's exactly where CapitalBad fits in. CapitalBad gives accredited investors access to private, operator, and sponsor-led acquisitions of real, cash-flowing small and mid-sized businesses. These aren't financial engineering plays. They are structured with aligned incentives, thoughtful downside protection, and long-term ownership in mind. If you're an LP, family office, or serious accredited investor looking to back disciplined operators building real businesses, CapitalBad is worth a look. You can learn more at capitalbad.com. I'll also put the link in show notes. That's capitalbad.com. And now back to the show. Now, trying to understand what else you do. Let's say there is an owner of a manufacturing business listening, like a potential seller, and they decide whether to reach out to you, to reach out to maybe more like brand name coastal fund. What are maybe 2 to 3 things you do and which you can say right away, like why they should maybe have this conversation with you?
Yeah, I think first and foremost, it will feel like an extremely different conversation with Speyside than the average PE firm. And the reason why is that we've all sat in that person's seat because we've been C-level guys at middle market manufacturing companies. Now we can do all the cool financial engineering as well. We all have really deep finance backgrounds also, but talking to somebody who sees it through the operator's lens is we found is like really incredibly valuable. It's different a little bit at Speyside because we have an integrated approach to deals and transformation after we've closed the deal. For us, our investment team they don't just do the deal and then like never talk to the company again. They're sitting on the board of directors, executing the deal theses, things like that. So much more integrated into, the transformation. So it's a completely integrated process from deal making all the way to, through transformation and then ultimately, some sort of liquidity event. So that part will feel completely different to the average person or average seller. It feels like they're talking to themselves a little bit more. Whereas, a lot of other PE firms, it's going to be much more of like a financial discussion and, deal execution discussion. We're going to have those discussions too, but we're going to spend a lot of time talking about how the business runs and, collaboratively, we can make it better and create more value and things like that. So what's kind of interesting, I would say, if you went to a management presentation that like Speyside was at, and you and you videotaped it and you turned off the video, what you would see is both sides taking notes. And you might say, wait, who's the buyer and who's the seller in the, at this table? And the reason why I would say that's true is because we take, again, a very consultative, collaborative approach to engaging with sellers because we really want to understand them. We really want to understand their business. And, a lot of times we'll suggest ideas to them in a management presentation and you'll see them write it down because they're like, oh, yeah, we hadn't thought about that. That's a really good idea. And we've even had some companies we bought, funny enough, where we suggested something in the management presentation, and then after we close, we actually ended up buying the company. And after we closed, and they said, "Hey, that thing we discussed in the management presentation? Well, we thought it was such a good idea. We actually executed it while you guys were doing due diligence. And by the way, here it is. So come check it out." So I would say that's kind of the difference. It's definitely an era of collaboration and consultative approaches versus more we're taking you over. That's just not how we approach it. We do a lot of listening because we know the folks that own these businesses. They know a lot about them and a lot about the industry, and you can learn a lot by asking questions and just shutting up and listening. So we do a lot of shutting up and listening.
Now, when it comes to, okay, there is this conversation, you find out it's another this hairy deal, but where is this red line for you? Like when it's even too much for you to do this. What has to be wrong, if we can say that?
So if you think about like an XY axis, what we think about in terms of our deals is that we're going to go through an S curve, basically. Other people will talk about it like a J curve in the industry. But the idea is that if the y-axis is like EBITDA and equity value, or equity value as a function of EBITDA, and the x-axis is time, right? Kind of what we know is going to happen in the first like 6 months. It probably things are EBITDA is going to go down a little bit, right? So you're going to hit the first inflection point on the curve, and then because of actions we're taking, usually 3 to 5 from our Portco value creation system, it's going to turn up. The curve's going to inflect, and EBITDA is going to start going up, and EBITDA and value creation, equity value is going to start going up. And then probably at some point we'll hit another inflection point on the S curve where EBITDA is still increasing, but just not at an increasing rate. And the answer to your question is we do not want that S curve to start below the X axis. Said differently, we don't like to buy businesses that have negative EBITDA, because what we found, just like in high school physics, when we learned about phase change of matter, right? So like think of water, to go from 0 degrees Celsius or 32 degrees Fahrenheit to 1 degree or 33, it requires a ton of energy, right? And it's the same thing, the same math basically applies to the S curve here, right? So if you're below the x-axis, it takes a lot of like energy to like make the first turn of the inflection point. But if you're below the x-axis, if you have negative EBITDA, it's like 100 times harder. So what we'd rather do is start with some positive EBITDA and go from there. So that's the quantitative answer. Qualitatively, we won't buy any businesses below 50 million in revenue. It's just a bright line. We've kind of learned. We've had some really good deals a long time ago that were below that, but we've also had the ones where we struggled were that those situations. No micro cap deals. It's just most businesses that are small, they struggle with systems and processes and structure, and therefore it's really hard to hire the people that you need to do a transformation with a small business. And then we also generally, rule of thumb, won't go above 500 million in revenue. And the reason for that is that we find that above a certain size, you're dealing with a lot of bureaucratic inertia. Said differently, you have to go too many layers down through management into the company to affect the people that actually affect the things that customers pay you for, which are making products, developing new products, or consultative selling. And if a company's too big, it's too hard to change it and transform it quickly. So if we're buying something that's a bit hairy, size matters, right? Too small is not good. Too big is not good. And so we tend to avoid that. So those are the two big things. Quantitatively, start with some positive EBITDA, and qualitatively pick the right size.
Not buying the company with a negative EBITDA. Did you learn this the hard way, or it's something you've always done, like not touching those assets?
A little bit. No, we've learned that over the years, doing the due diligence on those sorts of things. Get back to physics, like, body in motion tends to stay in motion, and it tends to stay on the vector that it's on. Right. So it takes time and effort and energy to change it. And it's usually the return on effort isn't worth it, is the short point.
Mm-hmm. Okay. Now, when it comes to the valuation of those firms, because you've bought businesses under 4x EBITDA and 8x or higher EBITDA. Maybe you can walk us through both ends, like what made one 4x and the other more expensive than 8x EBITDA.
Yeah, absolutely. So for us, we think about it in the context of the industry that in which the business resides, and then kind of like what's going on with the business in terms of what's an appropriate multiple. Generally, we're buying things at a discount to the industry. But, we consider things like, market dynamics, financial characteristics, go-to-market characteristics, operational characteristics, structuring characteristics in terms of thinking about multiples. Pardon me. So we're looking, for us, we're okay with doing difficult, hairy deals as long as it comes with a multiple discount. And we're okay dealing with companies where maybe they're not run perfectly, and therefore they're not performing great, and therefore the EBITDA needs to be improved. So for us, we tend to buy, companies in misaligned ownership structures at a discount, whose EBITDA is below where industry averages should be. So we buy them, we structure them, kind of dust them off, so to speak, and then fix them, and then we grow them and build them, and then we, either make a decision to hold them in a CV or we sell them. But the point is, we march toward a liquidity event. So again, it's relative. It's relative to the industry. What would be normal in the industry as a multiple? And then, what's going on with that business such that it's a value buy versus, a premium buy.
One very specific thing you've said has been that 20% plus of EBITDA from one customer equals 1 to 1.5 times multiple discount. So my maybe follow-up question on this would be, what's the best way a seller, maybe the one who could be listening this, can reduce that discount before they come to you or they go to market?
Yeah, I mean, what we've done historically, it's it's simple, but it's hard. And the answer is you try to sell more to other customers in the revenue portfolio. Now sometimes you have a customer who's concentrated and frankly, they're not very accretive to the EBITDA, and sometimes you need to divest some of their business as well, if it's neutral or negative EBITDA business. But the best way to do it, assuming that all that business is positive, is to go out and find new business from your existing customers, or new customers altogether, such that you just grow the whole pie, right? Think of it as think of that customer concentration as, if it's 20% or greater, so let's just say a quarter, if it's quarter of the pie, if you double the size of the pie, but they remain the same, then, they're only 12.5% of the pie. So that's the easiest answer, is grow the top line. It's again, it's simple, but it's hard. Like, it's not every business can just go out and grow sales easily, but and then you got to do some calculations around, basically value creation. What's more important to you? Is it keeping that customers, all of their business, and taking a discount on the exit multiple, or is it more important to improve the exit multiple by maybe divesting some of that business, so that it's not so concentrated? Generally speaking, we don't want to divest a customer's business. We just want to work to increase the other customer's business. That's the best answer for everybody.
Now, trying to understand the platform strategy, you mentioned a few times Portco value creation system, which has two phases. Could you please elaborate the phase one, like when it comes to improving the EBITDA and the value creation? Please go as specific as possible, and then let's discuss the phase two after that.
So we have our Portco value creation system, which is, the fix and build methodology or strategy that helps us execute the fix and build strategy. Phase one is the operational improvement. That's the fix part. And then phase two is the commercial growth phase. That's the build part. In phase one, and in that whole system, we have a framework for it that I built. That's a nice picture of a big wheel with 6 sections in it. 4 of the sections are in the phase 1 and 2 of the sections are in phase 2. So the 4 sections in phase 1 are commercial and go-to-market improvement, management and accountability systems, organizational design and capability, and then capital efficiency. If you said, "Hey, Pareto out, the 18 or 19 things that are in that phase 1 of, tools that you use, like what are the ones you do a lot?" I would say there are 3 big, focuses in or foci in phase 1. Number 1 is aligning and incentivizing the management team. Number 2 is rationalizing the revenue portfolio. And number 3 is optimizing the operational footprint. And the reality is those 3 things kind of like work together in concert a lot of times. And the reason why I say that is that to be able to rationalize the revenue portfolio and optimize the operational footprint, you need the right management team to do that. You need to have the, to borrow Jim Collins, framework, you need the right people on the bus and they need to be in the right seats. And we do a lot of work and due diligence through what we call our human capital assessment framework to understand, hey, what are the actions we're going to take in our 3 to 5 year hold period to create the value to do the, phase 1 improvement fix phase? And do we have the right people to execute those actions, whether it's members of the investment team, the operating partner, the CEO, the COO, the CFO, the CRO, whatever. Does the human capital in the business fit with the ability to do those things? So that's why aligning and incentivizing management teams are critical. We usually do equity LTIPs for all the management teams that we work with. We think it's really, really, really important to be aligned. And we want the management team to feel excited about executing the deal theses that, we're talking about, because a lot of times it's hard work, right? And so that incentive out there where they can create generational wealth by working with us, by having part of the equity of the company is makes a lot of sense to us. And then a lot of times they're rationalizing revenue portfolios, getting the right customers at the right margins in there, and then optimizing the operational footprint makes a lot of sense because once you figured out the right business to have, you got to figure out how you're going to service the customer. Well, that comes as a function of your manufacturing plants and your supply chain, and that has to be congruent with your go-to-market strategy. So you gotta right size that or optimize it, either shut plants down or consolidate plants or start plants up, depending on what's going on with your go-to-market strategy and how you're trying to service those things. So those tend to be, if you use the 80-20 rule, what are the 20% that create 80% of the results? I would say those are the major themes. That said, we will do other things. We always come in and we'll implement Speyside management systems, continuous improvement systems like through Lean or Six Sigma or Theory of Constraint. A lot of times, a lot of businesses we buy need information technology systems, a new or just a ERP system. In fact, we're like doing a corporate carve out right now of a company where one of their plants, they literally do everything with pen and paper. So they're going to need a new ERP system if we get that deal done. CRM systems, MES systems, all that sort of stuff. We'll also do like Salesforce effectiveness. Sometimes there's, we're doing public to private or carve outs where, new processes need to be put in, and we'll work on that. We'll do natural hedging. We'll optimize working capital and, things like that. We'll look at spend leverage, in the supply chain, with the model that we have on that. So all that sort of work. But again, the 3 big things in phase 1: align and incentivize management team, rationalize the revenue portfolio, and optimize the operational footprint. And then once we've done that, usually the EBITDA margins are, back to like industry level standards or near them. And then that's when, so we've done the fix part of things. And then that's when we go into the build part of things, which that's phase two, commercial growth. And we'll do that acquisitively or organically. Said differently, we'd love to do bolt-on acquisitions where they make sense for a company, especially if we have a nice platform after the fix part. Or we'll just grow things by doing normal things that companies do, like launching new products or entering new markets, going to new geographies, going to new channels, whatever it happens to be. But it's the goal is basically grow the top line. So think of it as like you know bring up the EBITDA margins, right, to and then like grow the sales or grow the top line. So fix first, build second.
Now, when it comes to the incentivizing management teams, what if the person or the people are not coming from the business? Do you ask them to co-invest with you when doing the deal, or you set it up in a different way?
We don't ask them to co-invest or make them co-invest. We will offer them to co-invest if they want, depending on who the person is and where they are on the management team, and how we want to incentivize them. But usually we are almost always setting aside a certain amount of equity, somewhere between like 5 and 10% of the diluted equity, as management incentives. But we don't like to force people to do anything. We kind of just don't think that works great. Like making people do something against their will, like usually that kind of creates resentment. So we try to be really, really hyper aligned, with our, we try to create alignment with our LPs, with us as the GP and, the investment team at Speyside, and then the operating partner, the OP at the Portco, and then the management team. So if we're all incented to get like a really high MOIC deal, that's what our LPs want, for their investing metrics. That's what we want for our carry. That's what the operating partner and the management team wants for their equity LTIPs. So being aligned and incentivized and, it is really important, because it's just more harmonious and it's easier to get hard things done when everybody's aligned and harmonious. It's kind of that analogy of rowing the boat. If everybody's rowing the boat in the same direction at the same pace, then you're going to get there a lot faster without capsizing. So that we tend to focus a lot on that, but we'll definitely let people invest in deals if they care to, or in the fund for that matter, when there's space.
Maybe there isn't a specific answer, but where do you believe that you guys create the most value? Is it in a fixing phase or the building phase? Because your system has fix and build.
Yeah, great question. I would say, and actually I've done this analysis, interestingly enough, and I did this analysis because I watched a video on YouTube, and it was a Warren Buffett video where he was talking about private equity being fraudulent. And I came away from that video thinking, he's not completely wrong at all about that. He's actually quite right for most funds. So kind of like, why is Speyside not fraudulent? And the answer is we create a lot of value in that fix phase, because usually we're trying to double the EBITDA in the first 2.5 to 3 years, at least double the EBITDA in the first 2.5 to 3 years. And that really sets up everything else, because it's not just about doubling the EBITDA, right? It's about creating a platform business with scalable, repeatable processes that deliver the results. So if you have a platform with scalable, repeatable processes, it's way, 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 way easier to go do acquisitions, because it's buying when you do corporate M&A, buying a bolt-on, that's actually really not that hard, honestly. Like, that's what everybody gets excited about, because that's what causes press releases, and executive management gets to pop champagne and all that. But here's the reality of the matter is like, that's only 5% of the work, right? So that's actually closing the bolt-on acquisition. That's when the work starts. That's that the work's not done then, because then the next 2 to 3 years is actually integrating that company into the platform. And that's where all the synergies are wrung out and the value is created. Said, back to your question, like what's more important? Phase one is really, really sets up everything else, because if you don't have a good company to integrate an acquisition into, or a great company on which to do organic sales growth activities, they're really, really, really hard, because essentially you have entropy in the system. And then doing one of those growth activities, either an acquisition or, a new launch, just accelerates the entropy and makes the business fall apart faster. So, fixing the company is really important, because that's the bedrock and the frame or foundation on which growth is going to reside. So phase one is the answer, is the critical part.
As this is the critical part, I want to maybe stop here with one more question. You have this system in this fixing phase, phase one, but sometimes things don't go so well. So, what are the reasons you found with your team when you do absolutely everything? You have this system, you do all those things, you find this maybe. No, I'm not gonna get into this. Maybe it's the people side. So the question for you is, what is this which you have found when things doesn't work so well? What was the mistake maybe you made in the phase one?
I would say it's maybe it can boil down to two or three things. Uh, I would say maybe we missed something in operational due diligence, where we made one assumption based on the information that we received, or the analysis we did, and it was wrong. And then we based the phase one approach on that information. And because that information was wrong, it wasn't a solid assumption, then it didn't work. That can be an issue. Another issue, and that's like, our fault issue. Number two would be bad assessment of human capital, which you were kind of alluding to. Sometimes we get it wrong in with certain deal theses, right? Where we think that somebody at the company can actually execute the deal thesis, and turns out they don't have the skills to do it. Because the reality of the matter is, pardon me, you don't get to spend that much time with the management team during due diligence. Usually the bankers, in fact, try to limit it on purpose, which is sometimes really annoying. But the more we get to spend with the management team, the better, because then we can assess them more clearly and whatnot. That's not the worst thing in the world, just because like we can always like fix that after we get the company bought. It just slows things down, unfortunately. And then I would say, just like, the third thing would be like, sometimes they're just exogenous variables, right? Like, we had one portfolio company that we bought a couple years ago, and it was before Trump got elected. And did we know he was going to go trade war crazy and do all these stupid tariffs? No. Like, now maybe some people who pay attention all day every day would have said, well, you should have known he was talking about doing certain things. But do we know how he was going to do it? Probably not. So that company, we dealt with it by buying a kind of like a sister company in the US. So basically they have manufacturing in more than one country, and it made the tariffs a moot point. But we didn't know. It's an exogenous variable. We bought that company several months before Trump got elected, and started, or well, I should say several months before he got inaugurated. So we just didn't know, right? But so things like that, it's like missed something in due diligence, didn't assess the human capital right, or exogenous variables throwing you a curveball or causing things to be a challenge that you didn't expect.
Now, still a question about the phase one, because I can see this is where the value creation is, as you said yourself. The phase two is only 5% of it all. So, what if there are some guys listening, think that the magic is in phase one, and they know all details about financial engineering, but they don't have the people like yourself who are capable of doing what you guys are doing at phase one. So my question is, what type of people should they look for to add to their team if they would like to do what you guys are doing?
It's a hard one because it's hard to find those sorts of people. And I'm not sure that it's so much about the people that you add. It's more about the orientation you take toward value creation, right? So the challenge you have in private equity a little bit is that I think probably like 90 or 95% of people that end up working in private equity come from investment banks. And investment banking is a great training ground to know how to build an LBO model and do a lot of financial analysis, which it's awesome. Like, I mean, I have an accounting degree and a couple finance degrees and, built lots of detailed models when I was younger and whatnot. And it's really understanding modeling and whatnot is an incredibly valuable skill because it allows you to form your logic and thoughts around value creation in a deal. The challenge, though, with only being able to model is that while you can come up with a strategy, it's sometimes hard to execute the strategy. So I see some guys that come from investment banking have an air of self-importance that, it goes back to they think like, the critical part of private equity is just getting the company bought. And the reality is like, you're generally not creating that much value just by buying the company. The value is created in the 3 to 5 year hold period. So getting the company bought is just the start of the race. The real race for value creation, equity value creation, and therefore carry creation is what do you do after you get the deal done? So carry isn't created at entrance, it's created after exit. And what you do between entrance and exit really, really matters. So I would, the advice I would give to the guys, especially if they're coming just purely from investment banking, is, hey, be open to the fact that, the operations of the company, during the, 3 to 7 year hold period, we tend to be a little shorter, more like 3 to 5, but in the 3 to 7 year hold period, it really, really matters. And you got to be diligent about that and, probably be open to feedback into the deal from more operating oriented folks while the deal is getting done so that you make sure that the assumptions that you have in your deal and your model are as accurate as possible.
Okay, let's insert into phase two. So, what makes your portfolio company like platform ready in your eyes, in your team's eyes, before you start doing those add-ons, expand, and buying more companies?
Yep. It's generally a function of the processes and systems that are available that are run by the right management team. So again, we talk about engineering the process stack, which is basically the activities that cause work to get done with the right systems, right information technology systems, with the right data. And that can get transformed into information on which you can base decisions with the right people. And once we have that going correctly, and we usually focus on the first 6 to 18 months to get that done and execute the phase one, so that things are starting to trend positively in terms of EBITDA. Once that's done, and that we've given it what I like to call the Speyside inertia, then it's time to start considering bolt-on acquisitions or new product launches or new end market entries or geography entries or channel entries. But that's the critical part, is that the company is ready and prepared to go with the right systems, processes, people, and data governance.
Okay. Now, a little bit about the companies you're looking for. You said their revenue-wise, it's 50 to 500, positive EBITDA, manufacturing, but maybe you could go more specific, like what exactly are you looking for? What would be the, like, a, I don't know, you see a deal, what must be true that you're like, okay, we're very excited, let's work on this now.
So the companies we usually buy are in some sort of misaligned ownership structure. So they tend to be underloved and undermanaged and therefore underperforming. And that misaligned ownership structure could be maybe it's a multi-generationally owned family business where the current generation isn't excited about working in the business, and therefore they just want to get out. It could be a corporate carve out. We've done a bunch of those. Larger companies or especially publicly traded companies that have an orphaned business unit or asset they just want to sell off. Those work really well for them and for us. It could be a situation where it's a company that just has too much debt. So we've done situations where we bought the debt to go through insolvency to get to the equity. It could be a publicly traded company that shouldn't be publicly traded. It's smaller than normally you would see for a publicly traded company, and we'll buy them and we'll take a public company and take it private. That works. Or the other place we find deals in misaligned ownership structure is sometimes like hedge funds or private equity funds a lot bigger than us. They will have assets that they've been holding on to for a long time, just because maybe like the guys that originally did the deal left or something, or maybe it's just not big enough to matter for them because they're such a big hedge fund or private equity fund, and therefore it's kind of underloved. We bought a business like that in Fund One, but we're happy to work with those folks to larger funds to, take something off their hands that they've owned for a long time that they need to get out of, or maybe it had some operational challenges that they didn't expect when they originally did the deal. We're happy to take on those companies and fix them. Or it could just be like, it's a really, really large fund that's buying portfolio companies that are, multi-billion dollar deals, and they're going to reorg that company. And similar to what I was saying before with like corporate carve outs, they're kind of doing restructuring, and a casualty of some of that restructuring is that they're selling off parts of the business. But yeah, so those sorts of things, like usually it's in some sort of the owners that currently have it maybe are not that excited about it for one reason or another, and we can, it's something that we are excited about, and so that part's usually true. And then the other part that's usually true is we look at it and we say, hey, it's a fixer upper, right? Think about like folks that like flip houses, right? They'll go in and they'll be like, I'll put in, I'll paint the walls, I'll put some new carpet in, I'll switch out the appliances, I'll do a little bit of landscaping, and now it's a good looking house. Or it's kind of how we think about things, a little bit too, which is like, hey, if this has been undermanaged, and under focused on the last several years, what are some of the things we can do to, using our Portco value creation system, phase one, and then potentially phase two, to make it a better business in our ownership period. So, basically we like underloved fixer uppers is the would be a would be a really simple way to say it. And we're very happy to work with people like sellers that, if they need a deal partner that need, where creativity and flexibility is needed, they should call Speyside, because we love doing those kinds of deals. They're super fun to do. we get excited. We get really excited about working with sellers to help get them done, and it tends to work out pretty well for both parties.
Okay, last few things. I would like to maybe discuss a bit about the overall market and the independent sponsor space, and it's because it's becoming more and more popular. I mean, raising a fund very hard, and in your own case as well, like Kevin had this exceptional outcome. Obviously, market was a bit different when it comes to debt and equity. Many years ago, uh, the deal you shared. So, what is your take when it comes to the current ETA independent sponsor, the market, whether someone should maybe raise a fund or just go deal by deal, or what's your take on the overall market?
Yeah, I guess my view of independent sponsor activity is like really positive. Um, so I don't think that you have to have a fund to make money. There are some benefits of having a fund. There are also some negatives of having a fund. So the benefit is you can call capital quickly. One of the big reasons why we raised a fund back in 2016 was that um, we were missing out on some deals because as an independent sponsor, especially if you think about like the kinds of deals we were doing, right? The company had to be structured. We had to figure out how we were going to transform it. And then like there were certain deals where we didn't want to write that big of a check. So we were out in the market looking for somebody to partner with. And so if you're trying to do all three of those things at the same time, structure the deal, figure out how you're going to fix it, and then, also like look for money, it's just too much to do, especially when you're on a tight timeline, relative to getting a deal done. And so, it was just easier for us to take one of those off the table, which is finding the money to do the deal. So now we have a committed fund. It's just easier basically we can backstop the deal. Now, actually, we still do a lot of co-investment for folks, especially for LPs in the fund. We always offer to our LPs in the fund first, and usually pretty good terms. And then we'll only go outside the fund if everybody in the fund doesn't take it all. Um, but so that's a little bit like one of the challenges or the good thing of having a fund. Now the challenges are like you got to do a bunch of fund administration work, right? That you don't have to necessarily do as an independent sponsor. As an independent sponsor, I mean, I'm going to grossly oversimplify this, but like, basically you can deal with the ownership structure all in the purchase agreement. Whereas like with a fund, you have LPs and, they're committed to the fund and you got to call capital and yada, yada, yada. So I think independent sponsor, the independent sponsor model is a pretty good, it can be a great model. And I'll tell you where it's really, really, really a great model is like, if you're somebody who has a lot of money, like if you have a lot of your own money and or a lot of contacts, then an independent sponsor model is pretty interesting. My one buddy I used to work with at Speyside, he's since spun out, Rob Sylvester. I remember talking with him about this like, I don't know, 5 or 7 years ago. And he was kind of jokingly saying about, the independent sponsor model, because we were talking about doing some more deals like that. And he's like, basically you should just have like a really standardized contract with potential partners where it's like a rip-off pad. It's just like check the boxes, fill in like the information, and then you got like an order for capital. And he was being obviously facetious. You could never do a tear off pad, but I do think he was right that if you have a structured, systematic process, doing independent spot, that would make doing in terms of raising capital or partnering with people if you need it, that would make it, a lot easier to do like sort of like club deals and potentially do bigger deals. But yeah, if you personally have a lot of money and you have a lot of contacts for, people that want to be in your deals, I think an independent sponsor model is pretty exciting and interesting. And the other benefits of it is that you generally don't have you're probably less likely to have hold periods, or constraints on hold periods. So usually in a fund, you got a certain amount of time to invest money, and then you got a certain amount of, certain life of the fund. And it's not completely confining or anything like that. But, if you buy a really good company and you're excited about it, and you have the capital to execute your deal theses, why sell it right away? Like, I think one of Warren Buffett's quotes, was, my favorite holding period is forever. So if you have a really good business, especially if it, has high free cash flow conversion, i.e., you can do a lot of dividends, then why not just keep holding that business? And it's a little bit easier to do that, in my opinion, in an independent sponsor model or a family office model. And a family office model is, you could argue, is just an independent sponsor model of a different color a little bit. So there are benefits of both. And I think you're good to your point, because we've seen so many, private equity firms implode recently, and it's so hard to raise a fund, a first fund. I think we're going to see more and more independent sponsors, and we've come across some really good ones over the last couple years, and yeah, we're happy. We will work with them as well. Like if somebody brings a deal to Speyside, and they found the deal and originated the deal, we're oftentimes happy to work with those folks to see if a deal can get done and partner with them.
Eric, it's been a good fun. I always wrap up with two like quick fire questions. Number one is what is the best investment advice you've ever received?
Invest in what you know. That's probably the best advice I've ever received. And then um, I think also, I'm not sure that this is investment advice, but I'm gonna say this one as well. My dad, when I was a kid, told me, basically, try to, find something to work on or in where you really enjoy it. And then, because you have passion for it, try to be the best at it. And if you're the best at something, don't worry about the money. Like, somebody will pay you well to be the best at something. It's well worth it. So I definitely managed my career that way. So I guess it's an investment, a time investment piece of advice maybe. But like, I love manufacturing, and I love what I do. It's like, uh I don't feel like I work. Like, I mean, I spend a lot of time, I guess, working 12 to 16 hours a day sometimes, and I don't mind at all, because it's like super fun. Like, it doesn't feel like work. So, and I think it's because my dad gave me that advice, and I pursued it. But yeah, invest in what you know, and find something you're passionate about doing, and be the best at it, and things will work out probably pretty fine in life for you.
And any great book recommendations? Anything maybe you read recently really enjoyed?
I I try to be a prolific consumer of books. And though I tend to be like economics, psychology, sociology, things like that. Right now I'm reading Trust Me, I'm Lying, and it's all about PR and media, and how basically the media works, which I find kind of interesting. Another book I read that was really interesting was this is a little bit nerdy, but Six Sigma for Sales and Marketing, or Sales and Marketing the Six Sigma way, which I thought was really really interesting. How basically like any process can be engineered and analyzed, and you know basically measured, is kind of what that book was about. So I really like that one. I really like The Creature from Jekyll Island, which is all about fiat money and how the Fed was started off back in the early 1900s. So because one of my degrees is in econometrics, basically like statistics applied to economics. So I really like a lot of economics stuff. So yeah, those would be, some of the most recent or faves, all time, I guess.
Okay, and the very last one, where can people find you if they would like to ask maybe more about the phase one of what exactly are you doing there, or maybe they would like to send you a deal, or maybe deploy capital in the future, because listening this episode, they can definitely say that, okay, these guys know what to do with those manufacturing companies when it comes to value creation.
Yep. So if they go to speysideequity.com, Speyside is spelled SPEY, SIDE. You can find my contact information on our website, or it's actually listed in my LinkedIn profile. My email and my cell phone number are both there. So or if they, hit me up on LinkedIn to connect and send me a message, I will do that as well. Just be a little bit patient on LinkedIn. I don't go on it every day, so usually kind of like once a week. But yeah, so website, LinkedIn, contact information on LinkedIn, or just LinkedIn direct.
Okay, Eric, I really enjoyed this conversation. Thanks a lot for doing this, and I really enjoy talking to you.
Yeah, no problem. If it helps to do a follow up at some point, happy to do it.
I hope you enjoyed this episode of Buyers and Builders. Please remember to subscribe wherever you're listening and leave a review. It really helps the show reach more buyers and operators. And if you already haven't, go back and listen to some of the other episodes of Buyers and Builders. This podcast is built for people who buy, build, and hold great businesses long term. Every guest you hear on this show has real, hard-won experience acquiring and operating companies, and the goal is, again, very simple: to give you ideas you can actually use in your own journey.